Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So markets in Asia are wrapping up what certainly has been a very rough week. And obviously the key driver, President Trump's latest tariff measures. Here in the States, we had a meltdown in risk assets. The S&P 500 tumbled more than 4.8%. We closed very near session lows. It was the worst single-day drop for the S&P since 2020. And in the process, this sell-off wiped out about $2 trillion in market value. We also saw a great deal of dollar weakness, with the Bloomberg Dollar Spot Index down 1.5% in New York trading. Oil joined in on a sell-off in commodities, with WTI falling 6.6% in New York. And in a moment, we'll be hearing from Steve Brice. He is the CIO at Standard Chartered Wealth Solutions Group. But we begin this morning in Sydney. Joining me now is Garfield Reynolds, who leads Bloomberg's Markets Live coverage for the Asia Pacific. Garfield joining from our studios in Sydney. Talk to me a little bit about what you witnessed yesterday, Garfield, with the price action across the Asia Pacific and what we're seeing now in early trading.
Yeah, the price action in Asia yesterday was extraordinary, but it was fed by an announcement that was confusing and opaque in its the presentation, in the methodology, which ultimately ended up being based on a very simplistic and not really credible on an economic basis formula. So you just sort of had waves of reaction every time you thought maybe the markets might consolidated. Either fresh investors came in as the time zones changed, or a greater realization came through at just how potentially damaging this is. And you were saying that the sell-off for U.S. stocks was the biggest since the pandemic, as it should have been, given that this is the biggest shock to the global economy since the pandemic.
And the question now is whether or not it precipitates a recession. Was it very interesting today that President Trump said he's open to reducing these tariffs if other nations were willing to offer something, and I think the word he used here was phenomenal. That says to me that there is the room to negotiate, but we may have to accept the fact that in that process, that could be quite lengthy, tariffs may be in place for a while. Is that fair?
Yeah, that's fair. And it actually adds to, there's an argument to be made that if you wanted to raise the average tariff rate in the US to something like 25 to 30%, then just do it and move on. And that's the avowed aims of the Trump administration, to increase revenue from tariffs and also to push foreigners to bring manufacturing back to the US, because otherwise they will be priced out of the US market. If you think that's the way to go, then you do big tariffs and you stick with them for at least a while. Maybe you give a timetable. You say these are going to be in for a year. But instead we have a situation where nobody knows how long these tariffs will be in for, what they will actually entail. So for businesses, you've got a lot of pain, but also a lot of clarity. And for most companies, it'll be, okay, I'm going to punt my business plans for 6 months, a year, until I can be sure what I'm dealing with.
So the sell-off that we had here in the U.S. makes for an unusual setup for what is really the most closely watched data point of the month, that being the government's report on employment. So in addition to that, tomorrow we're going to be hearing from Fed Chair Jay Powell. Obviously, the story on tariffs will make the Fed's job a lot more complicated. It seems a case of either the Fed lowers interest rates to support the economy, or it keeps them elevated to contain inflation. Where do you see the greater risk right now? Economic weakness or stubborn inflation? Or are they kind of evenly balanced?
Well, I think economic weakness is the greater risk, but part of the risks there are precisely that the Fed has the potential to sit where it is while it waits to see what happens. There's definitely an increase in inflation expectations. They were already concerned that there were signs that the disinflationary trend was stalling out. They had been talking about the idea that interest rates now are in a good place and they don't see any reason to rush to change them. And when you've got this, as I said, very confusing introduction of tariffs that could have major impacts on the US economy, you're going to have a lot of volatility about the data coming in and uncertainty about all sorts of data, and what the long-term impacts are actually going to be.
In terms of retaliation, what do we know about what we're hearing from governments in Asia? And I'm particularly curious about the Chinese response.
Well, China's response has also been pretty opaque. It's not at all clear exactly what they are going to do. They do have a track record of actually waiting until the tariffs are imposed before they announce their response. Now, that means we could be waiting till April 9 because the 10% on everybody comes in April 5, and then the additional tariffs come in on top of that on April 9. So does China announce some stuff April 5 and then more on April 9, or just everything on April 9? We've also got no real clarity on whether a TikTok deal will actually happen. A lot of talk from the US side that one is coming and that could lead to tariff relief. If that occurs, then that would take China retaliation off the table, you would think. But there's no clarity as to whether we don't really have much of a clue as to whether China is really interested in letting TikTok essentially slip out of its hands.
Yeah, I think that TikTok deadline is this weekend here in the U.S. Garfield, thank you so much for taking the time to chat with us. Garfield Reynolds there. He leads Bloomberg's Markets Live coverage for the Asia Pacific. And Garfield joining today from our studios in Sydney here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We're seeing further downside for markets in the Asia Pacific. This is after U.S. equities and the dollar suffered their worst day in years. Shares in Australia and Japan fell right at the open. For some market perspective, we heard earlier from Steve Brice. He is the CIO at Standard Chartered Wealth Solutions Group. He spoke with Bloomberg's Paul Allen and Haidi Stroud-Watts.
So it doesn't feel like we're going to see the volatility abate anytime soon. How do you sort of progress from here? What's your take on how to navigate these markets?
Yeah, so I guess everybody's now sort of just adjusting to this these peak tariffs that we've been seeing implemented in the US. And just trying to figure out what the next steps are, whether it's going to be retaliatory or whether we're going to see some sort of negotiations taking place. The likelihood is, of course, it's going to be a bit of both. And then the openness or willingness of the US administration to renegotiate these tariffs lower. So I guess everybody realizes this is bad for growth and good for it, and picks up inflation. So the question everybody needs to ask is, what are the scenarios from here, from a growth perspective? Is President Trump is he an idiot, or is he unconstrained? I don't believe he's either of those things. So he's clearly using this, or most likely using this as a negotiating tool to try and get a better trade agreements with different counterparties. And we're also seeing in Congress the Republicans have a voice again. So it's certainly not a majority questioning his leadership, but certain people now started asking the question as to whether this is the appropriate thing. And that leads to the point of, do we still have a Trump put? And we believe the answer to that is yes. The question is, when does that kick in? So for individual investors, with a long-term time horizon, this is where you make your money. You buy on weakness. Whether we'll see further downside, we still think we might see some further downside in the short term. But these are the great opportunities when markets go on sale for people to build long-term wealth.
Where are you buying the dip then if you were in that scenario?
So for the S&P 500, we're actually challenging one of the key supports that we highlighted yesterday, so 5,400. So we're just marginally below that at the close last night. Next one is around 5,120. So obviously that's a decent way away. So the way we would suggest this is saying, look, we should be diversified across different asset classes, across geographies in the world as well. But if you look at the US on a standalone basis, averaging buying to, from now down to those sort of levels probably makes sense, assuming we're right that Trump put is still there.
I want to take a look at the Magnificent Seven, although in this chart on the Bloomberg terminal we're now referring to it as the Lag Seven. But there's some really quality names here in bear market territory. Now, if you're willing to take a long-term view, is this the moment to get in?
So certainly, obviously we've seen valuations come off quite dramatically. So that was always the concern with these names, was that valuations are a big challenge. And now that's becoming less of a concern. They still have very strong fundamentals by and large. I think, names affiliated with Elon Musk obviously have different headwinds potentially than some of the other companies. So that's something that you have to factor into your decision-making process. But from our perspective, we are overweight tech, looking to buy the dip in the US tech sector as well, and so that would fit into this Mag 7 rebound at some point.
You're also overweight China. Now, the market there is closed today, but we saw some pretty modest declines yesterday compared to what we saw in the US. What's your outlook for China stocks?
So, we do feel that China will probably weaken a little bit in the near term. Obviously, the tariff effect, they have been pretty resilient. Obviously, the market's done very well so far this year. But we would be buying on dips there as well. We believe that the technology sector in particular is an area of key interest for us. Obviously, the DeepSeek revelation still feeding into a more bullish environment for tech sector. Valuations in China are pretty cheap still. So from that perspective, we like the Hang Seng Index, buying down, maybe 3-5% lower than we are today, and the same on the tech sector as well for the Hang Seng.
Southeast Asia, emerging Asia, obviously, is part of that China Plus One strategy, where some of the hardest hit in these tariffs. Do you still see opportunities when it comes to EM in this region?
So we're underweight ASEAN. So we're overweight China, underweight ASEAN at the moment, and I think that's one of the reasons was we felt that China was probably better prepared for the tariffs than maybe ASEAN. Obviously, that China Plus One strategy was a huge boon to the region, but I think that's something that's in the crosshairs of US policy now. Obviously the formula being used by the US to determine what tariffs should be is sort of symptomatic of that, and that's why ASEAN's probably facing significant headwinds at the moment. So, yeah, it's not an area of focus for us. Obviously, value will be created through this, in our opinion, if we think that tariffs are going to be transitory, or at least not at these levels. So we're at peak tariffs, but for us, our focus is elsewhere.
That was Steve Brice, Chief Investment Officer at Standard Chartered Wealth Management, speaking earlier with Bloomberg's Paul Allen and Haidi Stroud-Watts here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.